The Calgary real estate market is more split than ever right now. And this is something that we knew on the channel months ago because we had forecast data that we used to look at and started predicting that the split in the market was happening. And that is between different property types, different segments, and different communities. Now we cannot analyze Calgary as a market overall. We need to look at micro markets, the individual sentiments that are driving people from one part of the city to another, but also what decides whether they pick an apartment versus a townhome or maybe even a duplex. Hey guys, it's Iyer, your Calgary Realtor, and this is the channel that you want to stay tuned into to know everything that's happening on the data side with properties, where the market's headed, and potential forecasts that we pull out on this channel using the data, things that are not normally publicly available, and we draw our own hypotheses. Sometimes you're wrong, but let me tell you, most of the times we are right. And that is because I absolutely love data. I love to understand the underlying dynamics of a market and see where the economics are headed and make predictions that are not just every time is the right time to buy or every time is the right time to sell, but tell you what, we can inform your decision with all this data so that when you do decide to buy and sell, irrespective of where the market's at, you will do the best you can in that potential market. And that is what I aim to achieve with this channel. So if that's something that's down your alley and you would want to stay on top of the market and get updates like this, make sure you subscribe, and that will help me a lot to reach more people like you. Now, without further ado, let's get into this month's market update. In this month's market update, it is going to be quite a bit different because we're not just purely going to look at supply and demand just on the basics that the Calgary Real Estate Board talks about, but we're going to try and understand with everything that's happening on the policy side of things with the change in immigration, migration, and how that affects demand, where Alberta stands against other provinces, how we are different and maybe the same. It's very, very important to understand what's happening on a larger scale so that we can figure out what's going to be playing out over the next couple of years going forward. Now, I've put together for you a significant amount of data, so some slides we might have to go through a little bit quick. And of course, if you have any questions or you would like to expand on any particular aspect or even just chat about it, definitely drop it down in the description. I love to read the comments and engage with you guys. And you can also book a call with me because I love talking about this stuff. Promise you, I go hours on end, and I'm just super fascinated with data. So let's get right to it, and you will see what I'm trying to draft with the overall story and narrative of what's happening in Calgary and find the underlying reasons for where we are headed next. So first, right off the bat, as you can see, Calgary is actually less than 4% from its peak, which is one of the strongest performing across all of Canada. If you can see right here, compared to Hamilton, London, Kitchener, which have actually corrected 25 to 31% from their peaks. And there are two markets right now that are actually still at their peaks right now, and that is Regina and Montreal. But other than that, all markets are correcting overall. But when you compare a percentage seasonally adjusted, Calgary is down just 4% from their peak. So we're doing relatively really well compared to other provinces when it comes to pricing. If we take a look at the fundamental market dynamics that drive where the market is headed, which is sales, new listings, inventory, and months of supply, you can see that sales fell 12.8% year over year, while new listings also dropped 15.2%. So now both of these are softening, but inventory still rose by 4.7%. So since new listings also dropped at the same time as sales is not where it used to be last year, inventory did come up, but not as dramatic as you would have expected if, for example, the new listings stayed where they used to be. And that has led us to a months of supply of 2.87, and that is up 20% year over year. 2.87 is really just a balanced market. And that is the overall sentiment across all of Calgary, across all property types, across all communities. But we can no longer use this as a judgment of where the market is. And you will see in the next couple of slides why that is, because the market is completely divided in opinions right now. So trends differ based on property type. So if you look at total residential benchmark, we are down about 4.2% year over year. So we're down to 565. Detached is at 741, so we're down just 3.3%. Semi-detached is down to 686,000, which is down barely even 1%. So semi-detached, by the way, if you didn't know, is set to outperform detached even this year. And as far as row prices go, we are at 423,000, and apartments, this is 300,000. Now these are all benchmark prices based on a very specific criteria and specific house type. Depending on which community you go to, of course, the price will vary dramatically. As you can see, supply conditions in March vary significantly by property type, and inventory remained below the 10-year average. So we're going to see this in the next graph. The key thing to keep in mind as we go through this slide deck is that the market is divided. And the three things that we are going to call out in terms of where the market is divided is property type, the community, and the price points. These three make all the difference right now. So when we look at just by the numbers, the sales to new listings ratio right here, as you can see, shouldn't have moved that. So as you can see, the sales to new listings ratio for detached is actually 2.2. 2.2 is still a very strong seller's market. Of course, it comes nowhere close to the unusual level of seller's market that we had before, but 2.2 has huge price advantages still for the seller. As far as duplex or semi-detached goes, we are still at 2.49%. So 2.49 months of supply. So 2.49 months of supply is still in, I would say, sellers to balanced market. It's creeping right up on that balanced market line, but it's still a very advantageous market for the sellers. Now, on the complete opposite end, you have apartments, which is at 4.62 months of supply. So when we start looking at the sales to new listings ratio, which determines how quickly inventory on the market is going to get absorbed, you can see here detached is actually at 61%. So 61% of properties are selling based on how many new properties are coming on the market at the same time. Semi-detached also pretty close up there at 59%. So these are really good numbers both for detached and semi-detached. On the contrary, we have apartments actually right now sitting at 43% absorption rate. And in certain communities or certain districts, I should say, it's even way worse because it's actually sitting at like 29%, and we will see that. The other things to look at here is the total residential benchmark. So this is the summary by the Calgary Real Estate Board that really states where the market's at. Let's read through this really quick, and you can feel free to pause if you want to read it in more detail. So supply conditions in March varied significantly depending on property type. Inventory levels saw a typical monthly rise, but compared to long-term trends, inventory remained well above the 10-year average for both row and apartment-style homes, and well below the trend for detached. So when it comes to inventory, even though it looks like inventory is rising, we have a lot of inventory, a lot of that is actually towards row and apartment-style homes. Detached is actually below the 10-year average. There are 1,881 sales in March, up from the previous month, but still 13% lower than levels reported last year and below longer-term trends for March. So the decline in sales is mostly due to pullback in apartments, where increased supply choice and slower migration is spreading demand across a wider range of supply. One of the key things to know about how migration affects property pricing, property supply, demand, a lot of people that are on temporary foreign worker are not permanent residents or citizens. That is what fuels the rental supply. The rental supply demand then affects the investor money that comes into the market, whereas the actual purchase of resale homes is primarily driven by permanent residents and citizens. So it is two different markets that operate in parallel. And if investors see a lot of potential opportunity with the high amount of temporary foreign workers that we had over the last couple of years, they are going to pile money back into the market and that can then competes with the regular buyers that also want to buy those properties, and that then drives up or artificially inflates those property prices. But now, as policy changes, temporary foreign workers are not coming in as much anymore. Guess what? That investor money has left the market, and now it's all up to resale to capture that supply. And if they don't, then the prices stop balancing out, and that's exactly what's happening right now. So, when considering total residential housing statistics, conditions appear to be relatively balanced on sales, new listings, inventory, and prices all trended up over the previous month as we start to move into the spring market. However, when we look deeper, we are seeing a market that ranges from tighter conditions for detached homes to the apartment sector where conditions tend to favor the buyer. As expected, this is supporting upward momentum in detached prices and downward pressure in apartment condominium sector. So this is the chief economist of the Calgary Real Estate Board, and she very clearly calls out that divide. We of course caught on to that divide months ago, and we knew it was coming, and we saw that split in the market, but now the data clearly shows it. Now if you look here to further call it out, the detached benchmark prices are down just 3% year over year to 741,000. So that is right here. If you see the benchmark price, 741,000 in March 2026. Apartment benchmark in the same time fell 9.3%. So it went from 331,000 to 300,000. And being a realtor, I see the direct impact of this. You might think it's only a 6% difference, but that matters a lot to people. And right now, there are a lot of people in the apartment sector that I think are just in denial. And it's just the surge that we saw in the market for the apartments and townhomes over the last 2-3 years brought a lot of mom and pop investors into the market to diversify their portfolio and their investments, try to capitalize on the rents that were actually going up around the same time, because we saw such high amounts of interprovincial migration. But now that everything is reversed, these people are not as aware of how quickly the market can turn. At the same time, the rents are dropping and they are left holding the bag, but they still do not want to exit at this price point. They are in the belief that they will return to this point very soon. And my assumption is that we are in a severe correction when it comes to apartments and townhomes. So if you're not prepared to hold that property for, I would say, at least 6, maybe 7 years, and you think you would panic sell if it drops another 10%, you need to consider your options. And we need to find you better investment opportunities. So, and we will get into why that is, because supply and demand fundamentally are telling very, very different stories. So let's start by looking at demand. A lot of it, of course, comes from population and immigration. Where are we headed? Overall, right now, Canada has lost 103,000 people in Q4. This is the first time that this has happened in decades. This is unprecedented. We have not had population go negative. We've had population growth to at least a small extent, but go negative nationwide is unprecedented. And if you look right here, so a lot of this is because of the lack of non-permanent residents. So new permanent residents year over year dropped by 19%. So that's 83,000. Non-permanent residents actually dropped by 6% this quarter, right? So non-permanent residents declined by minus 171,000, and natural increase is now negative. So from Q4 2023, where we were positive, you can see the slow decline into Q3 2025, and then Q4 2025, you're just negative right now. How does this apply to Alberta? Specifically, how does it matter to Calgary? So as you can see here, 120,000 citizens and permanent residents have actually also left Canada. There's an e-migration trend happening right now where people are fed up with the taxes, fed up with the prices, fed up with inflation, housing prices, and people are looking for other opportunities, trying to move away from Canada. And these are not temporary foreign workers. This is citizens and permanent residents that are leaving, right? So there's this negative sentiment right now. And the reason this matters is because non-permanent resident departures are up 54%, and together these exits are suppressing net demand for housing, particularly in dense condo markets, so like rent-related markets. So for example, right here you can see in Ontario, they're actually negative 47% now. They're down by 47%. BC is down by 22%. And this is all relative to their population across nationwide. So Alberta, the reason it's green, even though it's down 11%, is because its contribution to the population levels across is about 12.5, 13%. So it's still below that. And that's why Alberta is relatively way better off than Ontario and BC right now. And we can clearly see the impacts on their markets because they were so heavily dependent on the investor money, the rentals, and they're seeing huge declines versus Alberta is still holding up its own. And this is something we're going to dive into a little bit more because while Ontario and BC have actually turned negative, Alberta is the only one that is posting a positive population growth of 1.2%. Do I think this will sustain? Possibly not. I think we will come down a little bit, but I do think Alberta still remains a very, very attractive option for anyone that decides to remain back in Canada to come and work in Alberta. And I'm seeing still a large amount of interprovincial migration trends. So the strongest rating of any Canadian province, this structural demand supports Calgary's housing market even as national conditions soften. So as you can see, Ontario, BC, heavily negative, and Canada overall also negative, but Alberta is still at 1.2%, and this is as of Q4 2025. Now, taking a look at interprovincial migration, the very thing that drove the entire market for the last 2-3 years and supported what most people thought was just going to go on forever. There was this huge amount of optimism, and I pity a lot of buyers that had to participate in that market because it was so hard to get into bidding wars, multiple offers, and a lot of people just decided to stay on the sidelines and just not take part in that. So Alberta is one of the very few provinces with net positive interprovincial migration gains. This is a powerful structural driver for Calgary housing demand, bringing working age buyers and renters from across Canada. As affordability, as inflation, as rents, as housing prices, are housing prices coming down in other provinces? Absolutely. But guess what? BC and Ontario still remains 18 times, 20 times the average salary. So is it relatively affordable than what used to be? Yeah, but it's not anywhere close to the affordability index. People are fed up, and in a quick sidetrack, the government's now trying to bail out the developers. They're starting to print money again. They put on the show for taking off the HST in Ontario that buyers don't need to pay that for new construction, but they're really only doing it because they know they cannot allow the housing construction industry to collapse there because it's responsible for 7 to 8% of jobs. And guess what? The government is actually teaming up with private vulture funds that are going in and buying surplus unsold condominiums in Ontario. And at the end of the day, who's benefiting then from that 13% discount to the house prices? The government. But also, the rest of the money, where are they getting it from? Your tax money. So they're taking tax money from everywhere else and trying to bail out these developers in Ontario. And it's just, of course, like I expected it. The government's going to come in. The government's always going to print money. The government's always going to try to not allow the economy to go through the correction, and that it just to pay for what it's done so far. And that's just how it works. That's how politics is. And just so many things. And now the other thing that I'm hearing, and again, we'll get back to the presentation right away, but quick sidetrack. I'm also hearing from Vancouver that they're now proposing for allowing or removing the foreign home buyer ban, so allowing foreigners to buy pre-construction condos again. Because guess what? Nobody else wants to buy these shoebox condos in BC and Ontario, and so allowing foreign investor money to come back, whether they really do, I don't know, but that's still to be seen. But they're trying to find other options now to put the housing market in these other provinces on life support. In the meantime, Alberta, right here, back to the presentation. Quick, that was not a quick sidetrack at all, but Alberta is the only one to post it's a 0.1%, but I'll take it as a win of interprovincial migration growth. Everywhere else, literally everywhere else across Canada, negative. So that's got to tell you something, at least in terms of countrywide perception towards Alberta, Calgary, and its potential impact. Now, mortgage renewals. This absolutely has to be spoken about because the cohort that locked in ultra low 5-year fixed rates we will never see again, and probably shouldn't, because that is just too cheap money. But 2021 to 2022 is now renewing at a significantly higher rate. So this adds payment stress, but not as much for Calgary. Why? Because this is the exact time when other provinces went down, we saw price growth. So we had perfect price growth all the way from here to here. Now imagine, as an investor, you got cheap money, you got to multiply your money. Do you really mind paying more interest to now keep those assets? You've built a crazy amount of equity. So what I'm actually finding in the market is this doesn't really matter for Calgary, because despite the amount of renewals coming up, all those people are sitting on a lot of equity, and now they have options. They can move to a bigger property, they can capture that equity and downsize. Kids are moved out of the home. There's so many options for people that got in at the market here and are looking to get out here. Now, let's take a look at the construction pipeline. So now we're talking about the supply side. Let's try and figure out what actually is happening. Break the story apart, because I promise you, headlines do not tell you everything that's happening. So right here, you can see after peaking in 2022, so right about here, the 12-month rolling home sales have retreated back, and that is no surprise. So sales have been slowly dropping since. This is an unhealthy amount of sales, and we shouldn't be at that consistently. So we hit that, and then we're heading back down. And you can see the long-term peaks over time, over the past, let's say, 2 decades. So particularly in condos and rentals, has surged to multi-decade highs, creating a meaningful supply overhang for the apartment segment. So if we look at just the condo plus single family dwellings under construction, so those peaked after, and generally new construction is always lagging behind the demand, because it takes time for new housing starts to actually even register as new homes. So for example, for apartments, for condos, it actually takes about 2 years before it even registers as new construction, because you have to get so once you excavate, you have to get back to grade, you have to put in the foundation, and that's when it starts counting as a housing start. So when you look at housing starts nationally, that is a severely lagging indicator. Those are all housing starts that were planned 2 years ago, right? So that hits about this point, and then once it starts hitting where the demand is not as much as it used to be anymore, so those start going down too. Now here is where the real story happens. When you break that new construction into multiple types, you can see that rental units under construction in Calgary has actually exploded to all-time highs. Condo construction has also remained elevated. Meanwhile, single family starts have actually flatlined. This supply imbalance will keep downward pressure on apartment prices while supporting detached home values. So, right here, you can see rentals are not stopping. They keep going higher, whereas single family has actually already started going the other way in 2025, and even condos started going the other way a little bit, then went back up. But what we are really having is an insane amount of rental supply. That's somewhere between 15 to 18,000 rental units supposed to hit the market over the next 1 year. And that is going to put extremely downward pressure on apartments and townhomes. Less so townhomes, but still it will. And then when we are talking about supply versus demand, this is where it's important to know the difference, because single family home new construction is going the other way. So, at the end of the day, district breakdown, understanding what parts of Calgary are doing well and what are not. Because, like we said, the market is split. So far, we've talked about property types. Now we're going to talk about communities. Which communities are splitting one way versus the other? So, if you look at, despite a 4.7% year over year rise in inventory to 5,395 units, Calgary's active listings have actually remained significantly below the levels we've seen in 2016 to 2020. So, all of these years right here, you can see we are well below those levels. And so, we're just basically hitting average. We're just a balanced market overall. And this captures just the supply. So there's a structural undersupply continues to underpin the pricing for detached homes. So even though on this chart we seem to be at the middle point and pretty much on the average, you have to still remember that a vast majority of this supply is still apartments and townhomes. It is not really detached and duplex as much. And that is going to keep putting pressure on that property type. So when we go on to looking at per district, you can see the West District, of course, still commands the highest benchmark price at 719,000. City Center is at 564, and South is at 574. And these sit near the city median of 565. Northeast remains the most affordable entry point at 473, and they are correcting severely compared to every other part of the city. Now, these benchmarks are not an accurate representation of what's happening with individual property types. That's where it's not just about a divide between property types, communities, or price points. It's also a combination of these. So when we start looking at a specific community, how is one property type doing against another? And that is what we will get into when you reach out, if you're buying or selling, trying to better understand your position in the market, because this market needs more data than we ever did before. Now, taking a look at by district, by property type. So, West, of course, leads with 108 sales with just 1.56 months of supply. That is an extremely tight seller's market, and 2.46 month over month gains. So West is doing really, really well right now for detached properties. To pull 2.46% in a single month is absolutely amazing. Southeast has the highest sales to new listings ratio at 88%. And this, I'm going to quickly show this to y'all at the end of the presentation, possibly, because it is extremely important and it proves the point of how quickly properties go. Or maybe I'll just do a quick story time right now. So there was a property in Southeast that I literally did an open house for last weekend. And honestly, I didn't expect as many people as I did. The average, if we see 10 families come through with serious interest, that's already a really good open house. Over that weekend, we had 50 families come through. We had 50 families come through with really high interest, not just busy, nosy neighbors. These were actually people in the market looking for their home. And that's why Southeast is right now doing so well, because almost every property that's coming on market is selling so fast. there's a lot of people in Southeast right now looking for properties. The stories for why they're looking in Southeast, of course, varies. A lot of people are looking for that entry into the market. They love certain communities in the Southeast. There are certain people from Southwest moving to Southeast because they're tired of all the multifamilies coming up next to them. And there's all sorts of reasons why people are looking in the Southeast. But this is an extremely high sales to new listing ratio. It is unprecedented, and it is very clear to see when you have boots on the ground and you host open houses, you talk to people, and you see the amount of interest. And for example, in Mackenzie Town, if you draw up how long properties are actually staying on the market, especially duplex homes, they're gone within a week. They're gone within a week, and we haven't seen that for a while now. But again, it is only specific communities, specific segments, and specific property types. Looking at semi-detached, you can see right here the city center leads with 63 sales and a 71% sales to new listings ratio. Again, that is a very high performing part of the market. North has tightest supply at just 1.74 months. City center fetches a 949,000 benchmark. So that's the city's premium semi-detached district. Overall, semi-detached is performing robustly and set to outperform detached too in 2026 as far as the forecasts go. Northwest saw a month over month increase of 2.38%, another big winner in this segment. So like the detached, so in duplex, 2.38%, that's a massive month over month gain. So generally it's always the west and the northwest that lead the market in terms of gains, in terms of seeing the highest amount of sales go out first, because of course that's where people first prefer. And then the order of priority is to go to south after, and then southeast. However, this year I'm seeing a lot of demand in southeast, and that is ironic because the predictions were due to the high amounts of construction that was happening in southeast, that southeast would actually see a huge drop in demand and prices would have to come down and correct because people are going to compete with the new construction. But let me tell you, from that open house that I did, the conversations that I had, people, it's either they care or they just absolutely don't care for that new construction. A lot of people are passionate about older communities, about the way homes used to be constructed, the architecture style. For example, in Mackenzie Town, it is heavily done through the Victorian architecture style and Queen Anne style. So a lot of people love that, and they don't want to go to cookie cutter, zero amenities, new construction properties, despite the pricing difference. People would rather stick with established tree-lined street communities. And so, in a turn of events from what people were actually expecting, communities in the southeast are actually really holding up for their own. Now, looking at rural townhomes really quickly, southeast leads the rural townhome sales with 60 transactions. City center commands a 584,700 benchmark, 63.86% sales to new listings ratio, and east is the most affordable row. No surprise there, despite already seeing 11.4% drop year over year. Now, row homes overall sit at 51.1% sales to new listings ratio, which is a 2.98 months of supply. So, row homes have actually made a turn where certain areas are selling better than we expected and sort of just pulling up the whole segment overall. So, it's just a balanced market. However, Northeast still continues to face a completely opposite with 6.41 months of supply. So that again is an extreme buyer's market. You have a lot of advantage in the Northeast right now with row townhomes. And as far as like apartments go, City Center has the most apartment sales, 167, no surprise there, but a weak 41.96%. So a lot of properties are still sitting on the market and not selling. Northeast has a 30%, Southeast has a 38%. So this shows the weakest conditions. Months of supply range from 3.8 all the way up to 8.4. That is abysmal. And That is a very painful market to be in as a seller. If you're at 8.4 months of supply, you have to price correctly. Your staging, your strategies, your marketing is extremely important. And the realtor that you pick and you decide to go with is going to decide how your property works out. Because the last thing you want is to be a stale listing and to be catching a falling knife. All squarely in buyer's market territory right here. So most districts have actually seen a minimum of 10% decline in year over year pricing. And that is what's dragging anything that you see in headlines or the property market overall. Now, when we look at months of supply, apartments are what's carrying the surplus across all districts. So the bar makes something that is completely unmissable. So apartment, so these apartment bars. So this is the months of supply for each part of the city. So as far as when you look at the apartments, those are way more than any of the detached or semi-detached. So detached and semi-detached consistently are sitting between 2 to 3 months of supply overall on both sides. You can see even semi-detached. But when we look at apartments, you're starting out at 4 months of supply and then you're going all the way up to 8 months of supply. So apartments is what is right now very clearly the pain point in the market and where the divide lies, and does not clearly represent what's happening in the market overall, because there are of course other parts of the market that are doing really, really well. Of course, it comes down to your strategy. Now, finally, looking at the price growth momentum has decelerated sharply from 2021 peaks. So at 2.87 months of supply, the residential market remains slightly below the balance threshold of 3 months, but the trend is headed still continuing upward. Now, the price growth in the same time has actually turned negative on a year over year basis. So we've dropped below the 0% line, and price growth has changed direction. So things are balancing back out as money just rearranges itself through different parts, different economy, different property types, and different sort of investment vehicles based on whether it's a buyer or an investor in this market. So as you can see, we're turning back around. I do not expect that we will hit the zero and go positive. As far as year over year calculations go, I do expect us to balance out just somewhere in between here, so 0 to 3%, and then we will just mostly trend sideways for a little bit, something like what we saw back here. Now, semi-detached in the northwest and west are the only submarkets that are showing meaningful positive year-over-year growth right now. So semi-detached right here, you can see, and apartments are universally negative, and most districts are down over 10% or more. That is just the apartment sector is going through a lot right now. Detached shows relative resilience, so with most districts nearly flat to just a little bit negative, whereas West is still showing positive gains for detached homes. And now, finally, something that's very, very important to keep in mind. Of course, if you've been on the channel for a little bit and you've watched one of my past videos, you know exactly what I'm talking about. It's the traffic light analogy. So when the market resets, when the apartments and townhomes are not the ones leading the way anymore and they go to the back of the line, guess what's at the start of the line? It's the luxury detached segment of the market. And that is exactly what we're seeing right now. So when we compare the 1 million segment, has actually held or grown its share of total year-to-date sales in 2026 relative to prior years. So even as mid-range and affordable segments contract, now if you compare all across all segments, you see the significant drops. However, the affordable range, generally there'll be two ranges that will hold up relatively well. So the sub 300,000, because there's still first-time home buyers, entry-level people trying to get into the market, and those sales will kind of hold out. And then you have the mid-range of the market, people looking for value. So people trying to capture good square footage, bedrooms, average homes, growing families, and still pay relatively affordable prices between the 500 to 600,000 mark. So that still holds up relatively well. And then finally, you can see here we have now gone back to the luxury market leading the way. So if you've watched that video, you know what I'm talking about, but if not, I'll just quickly go over it. So luxury sales are holding up really well. Luxury is still seeing multiple offers. Luxury is selling fast. And that is because now, once the lower end of the market starts becoming very expensive and people back away from that, the luxury all of a sudden now seems like a relatively good deal. It's not the same buyer, but the market just gravitates back towards that. And that leads to the price increases in luxury. Then, once the delta between luxury and mid range detached and upper end of the properties starts getting too wide, then you have something called a substitution effect. So people will move from this segment over to what is then the next best and where the value actually lies, because this now becomes a little too expensive. And so people then trickle, cycle down the real estate chain essentially, and different properties pass through the traffic light. That's why it's called the traffic light analogy. And then eventually, at some point, instead, you can't tell, maybe 5 years, 6 years, 7 years, 8 years. Guess what? Apartments and townhomes will be expensive again, and we will be having the same conversations. So that's just how it plays out, and that is the real estate cycle. Taking a look at just the overall stats to close it out. So taken together, sales are normalizing towards longer term averages. So as you can see here, this is the 10-year average. We're just right about there. Things are getting normal again. We definitely do not want this again, which is 2022. New listings are tracking similarly. So again, at 10-year averages, this is perfect. I love a balanced market. It's fair to everyone. There's good value to be found, and it does not put anyone under undue pressure and does not bring bad actors into the industry. So modestly with gains through the spring market, and then I would expect months of supply to be ticking upwards, but still well below the distressed territory. So months of supply, as you can see, overall just is going to keep trending up, but we're not going to go to crazy 10 months of supply across the entire market, for example. And then the Calgary market is just basically recalibrating. It's not collapsing, but yes, it is split. And that's it for this month's market update. It was a lot of data for sure. Hopefully, I kept it entertaining enough, threw some stories in there, and you found it super valuable and it informed your decisions going forward. And that's what this is all about. And if you are in the market right now looking to buy, sell, or invest in the next little time, I would highly encourage you to reach out. I would love to have those conversations with you so I can provide you more specific data that would absolutely help you to make those crucial decisions and not make a mistake, because in this market, a small mistake can stack up really, really fast, and then you become a stale listing, or you've looked the wrong way and a good property, an opportunity was lost. So depending on where you're at, I would absolutely love to have those conversations with you. I've put this entire slide deck for you to download and refer it to you like on your own time schedule, because of course there's a lot of numbers on there that I haven't gone through. So I'll put it down there, quick download. It'll be down in your email within a couple of seconds, hopefully. And if not, you can also get the buyer guide and the full community guide. These are extremely, extremely valuable. A lot of people have given me such good feedback, especially on the community guide side of things, because we also go into the actual vibe of different parts of Calgary. So if you're new to Calgary, that's what you're going to find super valuable. I hope you found this video extremely useful. I look forward to hopefully helping you through navigate the Calgary real estate market. And if you haven't yet, subscribe, and I'll see you guys in the following video. Till then, take care.